Hello, hello, hello. What's going on, everybody? Hopefully you guys can hear me loud and clear within the YouTube audience before I get started here. You should be able to see the screen, just some text on the screen, normal capital hungry banner. No webcam today, as I need as much screen space as possible today for all my typing and all the information I'm going to be giving, because this is a very important week in the markets. Now, of course, I'll be giving you guys some trade ideas for potentially the next sessions to come, Asian, London, and New York, but this webinar is primarily to give you analysis, information, prep, and scenarios for the more important fundamental catalyst this week being the interest rate decisions. We have the Federal Reserve rate decision Wednesday, if I'm not mistaken, Wednesday afternoon. And then the following morning, we have Bank of England and ECB. Now, the Federal Reserve interest rate decision is the most important, as they're pretty much the leader of the pack of the major central banks, and because they're the cartel of the currency, the US dollar. And the US dollar is the world reserve currency and business currency, so it holds a lot of weight on a global scale. So we're going to be doing some fundamental breakdown and educational information first on understanding the Federal Reserve's monetary policy, what we have seen so far, and what to expect in terms of scenarios just from the Fed rate decision. Then we'll talk about Bank of England, ECB, and so forth, right? So, interest rates week. Get your notepads, get your pencils, get your laptop, get ready to start taking some notes and studying. Now, the Fed interest rate is more in focus. The Federal Reserve, have been raising rates since 2022 to combat inflation created by their own loose monetary policy and greed into the markets alongside the whales and one percenters. So every 10 to 15 years, there is always some type of crisis that brings mass uncertainty, panic, and fear to the markets and to societies overall, especially in these developed nations, which we've seen repeat throughout history with the 1980s crash, 2000 dot-com crash, 2008 GFC, 2019-2020 pandemic, right? Now, every single crisis has always led to an opportunity for the rich and the people who are wealthy that have the resources and capabilities to take advantage of the opportunity presented by the crisis. Every crisis always has a very similar blueprint. The crisis first comes into play and brings mass fear, uncertainty, and doubt, and you have various asset classes crash or heavily decline in price, setting up very low prices on investing asset classes from gold, stock market, oil, crypto in the example of the pandemic, real estate, and so forth. After these prices have a major correction, decline, or crash, then the central bank comes into play to pretty much bail out the economy, make sure that the stock market doesn't fully go to zero and crash, and also start to create very favorable investing conditions for the people that have the resources to take advantage, mainly the larger institutions, corporations, one percenters, and people of high wealth. Once the pandemic happened and led to gold during that period of March 2020 having a significant dip in price, oil, crypto, and the stock market having a significant dip in price, it was March 2020 where the Federal Reserve came into play and had a very loose monetary policy, pretty much pumping the markets, exponentially increasing money supply, taking that money supply and purchasing assets through their asset purchase program, credit allocation down the line, government bond buying, and so forth, and still keeping interest rates very low and at zero. And then you have the whales riding this wave. What wave is that? Well, you have all these asset classes from 2020 market crash with pandemic at lower prices. Stock market, gold, real estate, crypto, oil, and so forth. You also have very favorable investing conditions as you have low interest rates, makes it investing activity investing activity increases at a rapid rate because you have all these institutions, corporations, businesses taking out loans, reinvesting those loans into their business growth, or of course into the markets for gains, and then a huge cycle of money being flooded into the markets and turned into market profits. As obviously what we saw take place is during the period of low interest rates and money pumping into the markets and whales riding that wave from low prices, we saw crypto go from 15K in the example of Bitcoin to 70K. We saw Dow Jones in the example of US 30 and US equities go from a crash point of 18,000 all the way to new record all-time highs at like 36,000. We saw gold go from like $14.50 an ounce to $2,000 an ounce. We saw oil go from minus $40 a barrel to $80 a barrel, right? Now, this is all fine and dandy for the rich and wealthy. As they're getting even richer, their investments are increasing in value, their wealth is further expanding, and the gap between rich and poor further widens, as seen throughout any other crisis from a financial perspective in history. But there's a cost and sacrifice that comes for everything. That extreme pumping of the markets and printing of money and low interest rates and whales riding that wave, and all those asset classes exploding in value from 2020 to like late 2021 had the side effect and impact and cost of extremely high inflation. Not hyperinflation, but high risk inflation. US CPI soaring to 9-10% year over year, and it can get out of hand very quick. Now, inflation to a certain extent is beneficial to the rich. The people, the ones who pay the cost and pay the impact of inflation are the people, the general masses in public. So the same time during the pandemic timeline where people were locked down, they lost their jobs, they're being fed all this propaganda, they're being programmed and misled, they have to follow all these rules to social distance or stay in their home or can't go to the gym or can't go here, can't visit family. They have to comply to all these rules. They have to get all these vaccines. They lost their small business and so forth. During that same timeline, behind the scenes, there's trillions of dollars being moved into the markets in terms of gains and huge amounts of wealth accumulated for the big players involved, aka the one percenters. And during that time, as the Feds exponentially increase money supply, that's going to have a direct correlated impact to increase inflation. Now, the simple definition of inflation is that when inflation is rising, every single item within that economic bubble increases in price and increases in value. The majority of one percenters' cash flow goes into investment and ownership. For example, when you have somebody running a large family business, whether it's in oil and other commodities, or whether they are running a corporation with a board of directors, the majority of profit that they earn is not spent in consumables or is not just held in free cash. It is reinvested into the markets, reinvested into acquiring more businesses, owning more land, owning more real estate, owning more commodities, increasing their size of their investment portfolio into the stock markets and so forth. So inflation increases the value of all these assets that the wealthy and rich own, making them even richer on top of these other confirmations and catalysts leading to asset classes exploding in value, like the whales riding the wave, low interest rates, Feds pumping the markets and so forth, right? But inflation to the general public and masses is extremely deadly. The majority of free cash, meaning like cash earned by the day-to-day citizen, goes into consumables. A good chunk of it is something that's completely out of their control, not even in their choice. They have to pay to live, right? They have to pay their rent, you have to pay your internet bill, your phone bill, all your grocery bills and so forth. And then outside of that, due to societal programming and how this financial system and societies are set up, any extra time and money that the general people have goes into consumption. Buying some more useless materialistic shit you don't need, buying some more nonsense, wasting your time on Netflix, wasting your time and energy on just consumption. So for the rich and wealthy, their basket of ownership increases in value and their overall wealth increases in value. But for the general masses and public and poor, all that happens to them is that their cost of living and their cost of survival goes up, making it harder to buy the same amount of goods they buy at the grocery, or paying more at the pump when going to put in gas in their car, or real estate costing a lot more for people who just don't even want to invest in a house. They just simply want to start a family and have a place to live, right? Now, inflation, even though it is beneficial for the rich to an extent, inflation is a very dangerous economic game to play with. Inflation, if it rises too fast and too high, can reach hyperinflation levels and spiral out of control in a very volatile fashion, right? So understand that you can see examples of this in recent times if you look at Venezuela, even Argentina, if you look at Zimbabwe. You can even see it historically if you look at Germany post-World War and other countries that have suffered with hyperinflation through their through either history or even recent times right now, as stated, right? The issue isn't that US CPI was reaching hyperinflation levels. The issue is that once US CPI is at high risk levels, it can extend into hyperinflation levels in a very short period of time. So then from after 2020, money pumping in the markets, 2021 continuing that same sentiment and pumping the markets up, the rich getting richer, the feds had to come in and shift their monetary policy and start to change the financial conditions that the greedy stock market buyers were loving so much. The reason that they had to change these financial conditions and shift their monetary policy was that their goal went from supporting the economies and supporting the market to now that job is done. They've completed that. The low interest rates, the money pumping, it propped up the economy as artificially as you could do it. Stock market at all-time highs, oil back to $100 a barrel, gold at $1,800 an ounce, real estate very bullish as well. Now, what their primary goal from April 2022 to what we saw take place for the majority of 2022 was to bring inflation down, right? So the feds have been raising rates since 2022 to combat inflation created by their own loose monetary policy and greed into the markets alongside the whales and one percenters. Rate hikes were front-loaded in the most aggressive historical fashion that we've ever seen before. And the market was pricing in those rate hikes from April 2022 to November 2022, as we also had consistent month-over-month data reports to support the Fed rate hike cycle narrative. This is what we coined in Capital Hungry, and if you remember the webinars last year, as the dollar domination era. During this 8 to 9 month period, as the Federal Reserve was front-loading rate hikes, not increasing money supply anymore, not pumping up the markets anymore, tapering off any stimulus, and of course, having their focus go from supporting the markets and economy to bringing inflation down, this is where we saw dollar bulls, gold bears, and stock market bears for about a solid 8 to 9 months through 2022. But from November 2022 to now, the markets have been pricing in the hopes of a Fed pivot. Remember, the greedy stock market buyers, the greedy corporations, the greedy institutions, they don't like these tighter financial conditions. They don't want high interest rates on their loans and on their business-to-business activity. They don't want the feds to stop pumping the markets. They don't want the feds to focus on inflation. They want to continue extending the stock market even higher. They want to make more money on real estate. They want to make more money on oil and these other commodities. They want to get even richer, right? So even though from 2022, April to November 2022, the dollar domination narrative was holding the most weight, and we saw the stock market enter a bear market. US 30 go to revisit pre-pandemic highs. We saw US dollar go to 25-year historical highs. Euro USD melting, GU melting. We saw gold go from $2,000 an ounce to $1,600 an ounce, which we predicted as well and called out every step of the way. But that narrative goes against the greedy stock market buyers and what the corporations and institutions want. The institutions want the same conditions where the feds kept interest rates low and they were pumping the market. So any catalyst that potentially signals through a Fed pivot, such as declining CPI or bad US economic data, the market starts pricing in the potential chance of Feds pivoting and going back to easing monetary policy and loosening the financial conditions, easing the financial conditions, giving great investment environment for the rich to get even richer, right? This is why from November 2022, and since then, ever since we've had declining CPI and bad US data, we've had dollar bears, gold bulls, and equity bulls, right? CPI has declined for 3 consecutive months from a rough 9 to 10% to a rough 6 to 7%. US data from consumer reporting, such as retail sales activity or PMI figures looking at various sectors, has started to decline, showing the US is in a potential deeper recession. The only way the Fed would pivot and would potentially stop the rate hikes and potentially cut rates again and go to ease monetary conditions are 2 catalysts. One, their job is being finished and inflation is starting to reach their goals, declining to 2% or showing consecutive decline to that. Or even though the job on inflation may not be complete, US economic data is getting so bad that the economy cannot handle more rate hikes. So every single bad data report, the markets start pricing in the hopes of a Fed pivot, and you have dollar bears, gold bulls, and equity bulls. Now, this FOMC is heavily in focus because what the greedy stock market buyers and corporations and institutions want is the Feds to start slowing down their rate hikes, is the Feds to go back into easing easing financial conditions and giving them more favorable environment to have stock market go higher, dollar continue lower, oil continue higher, housing continue higher, and so forth. But understand this, even though inflation has been declining month over month for the last 3 months, we are still very far away from the Fed's goal. The Fed already understands that the economic data is going to worsen. The Fed already understands that inflation goes down in waves. The Fed already understands that they need to keep rates up for an extended period of time. CPI is still sitting at 6 to 7%, not even close to the 2% goal. Pivot has not been confirmed by the Feds themselves. This is why this FOMC is so heavily in focus. And inflation moves in waves and episodes. 3 months of consecutive CPI decline is not enough to say the fight on inflation is over and for the Feds to pivot. Actually, having these asset classes in commodities like oil and having the stock market still so very bullish is actually counterproductive and still leads to increases in inflation as well. It's just that the greedy market buyers, the 1%ers, they want the Feds to pivot because they don't give a shit about inflation. They'll be rich regardless. They'll still have ownership of these assets, ownership of the land, ownership of the companies regardless. They just want to get even richer as fast and as quick as they can. That corruption of human greed in the pursuit of power. But the Federal Reserve cares about inflation to an extent because if inflation does get out of control, it will completely murder the engine of the economy which is your day-to-day worker, your day-to-day citizen, right? So, in my opinion, right, I'm going to mark out the scenarios as well, but in my opinion, I think the Jerome Powell and the Feds this week are going to bring the heat and bring potentially dollar domination back to the scene and talk about that inflation is still very high. Inflation is not close to their targets yet. They still need to keep conditions tight. They may need to keep interest rates up into 2024. They may need to do more rate hikes than people expected as well. And they may need to continue their fight on inflation. The market's getting too ahead of the curve. The market is getting ahead where they are not even close to their goals. If the Fed brings a very hawkish sentiment and speech, when you're looking at some of these asset classes like gold, we are at very key higher time frame points into this new year to have institutional sellers jump back into the market and still maintain market stability. We're at very key price points when you're looking at the stock market here to have stock market buyers offload still from all-time highs and sellers come back into play, extending the bear market and coming back down to price points that we've already been seen before. The market's already been adjusted to it before, still maintaining price stability in the markets, not creating any mass panic or any potential for a crash, still maintaining the integrity of a bearish market in the stock market overall. And we can also see that in the example of the dollar, on the higher time frame, that the dollar in this new year has done a very significant pullback to retest previous historical highs, 50% correction of this impulsive, monstrous bullish rally, retesting a key previous liquidity zone, where if we start to see the Feds bring a very hawkish speech, start to kill some of the market gains, focus on the inflation fight, saying we're not close to being done yet, dollar can start to be trending back to these highs as well, right? I personally think that the Feds may bring the heat. Jerome Powell has a very solid understanding of inflation from a historical perspective. And let me show you guys another example of a mistake the Feds don't want to repeat that's been seen in history before. So let's come here and let me show you guys a chart quick here. Okay? Let me find it 1 second here. So this is US CPI year over year, but from the 60s and 70s, right? You can see here we have a very similar situation where during this period of time when interest rates were low, you were having money pumping into the markets, loose financial conditions, you can see that you had a pretty significant increase in overall CPI over about a 3 to 4 year period, starting to near 6%. From this area, you can see you had consecutive declines in inflation here, even when we were nearing the high risk levels here, even when we were nearing here. But the Feds did not stick to their hawkish monetary policy. They started to pivot relatively early and started to feed into the stock market narrative and greed instead of focusing on inflation. Even though you had inflation drop from 6% to 3% here, or from 12% to back to 6%, because the Feds didn't put the pressure on rate hikes and keep rates up for an extended period of time, that decline in inflation was relatively short-lived, and we soared to even higher figures seen historically here, right? This is a very similar type of a situation with what we're seeing with inflation now. Yes, we're starting to see CPI decline a little bit here. Put this right here. Okay. So you can see here, this is like a rough, this is the wrong one here actually. US CPI. Okay, this one, there we go. Okay, so you can see here that through the pandemic period, as of course you had the central bank exponentially increase money supply, start pumping the markets. This is going to directly result in economic inflation skyrocketing. Inflation on the US CPI year over year skyrocketed to high risk levels of 9%. 9 to 10% is considered high risk, where if you don't start to take action on combating inflation, you can easily enter hyperinflation territory in a very short period of time, and that completely destroys the market. Now, yes, we're having some consistent declining inflation data, potentially coming back towards the goals. But the Fed's goals is bringing inflation back down to 2%. We're still very far away from 2%. We're not even close to correcting some of the upside in inflation through the pandemic period. And if the Feds were to pivot and feed into the stock market greed and slow down rate hikes, or even start to cut rates and ease financial conditions, US CPI would follow a very similar path to what was seen in the 70s, where yes, you may have had some short-term decline in inflation, but the market got way too ahead of the curve, got too greedy, the central bank jumps the gun on cutting rates, and you end up having an even higher surge in inflation and a larger wave and episode of high inflation the following years after. This fight on inflation, where especially the economic bubble in the US is a lot bigger compared to the 1970s, we had trillions of dollars increase in money supply, huge amounts of money printed and pumped into the markets. This fight on inflation can extend for years. It can take years as you have episodes of inflation going up and down to bring it back down to their goal of 2%. You can even see here that you got close to the 2% goal, still jumped the gun. It was at 3%, and boom, huge episodes and surges in inflation, right? I think Jerome Powell is smart enough to understand how this works because he's a fucking Federal Reserve head. He's very knowledgeable and understanding of this as well as the other Fed members. And he was there during the 2008 global financial crisis when Ben Bernanke was the head. So we got to learn a lot from that as well, with how to manage inflation, control it, and how tightening of financial conditions can work. But during the Bernanke era, we had a strong error by the Feds, which was the taper tantrum, right? But that's a different conversation. That's another educational webinar. Anyways, just because inflation has saw a couple of months of consecutive decline doesn't mean the fight on inflation is completely over, especially as the majority of these asset classes are still sitting very high, and at the pump or at the checkout for the consumer, prices are still very high compared to prior pandemic. If the Feds were to start pivoting right now and slowing down rate hikes or cutting rates again, yeah, we may see inflation trickle down a little bit more, but it's just going to end up going up even higher, completely counteracting the work and action done by the Feds. I think the Feds are going to bring the heat back in terms of the pressure on rate hikes and the pressure on fighting inflation. And I think that these asset classes are at a great price to see an offloading of the stock market while still maintaining market stability, and dollar turning bullish again while still maintaining economic stability and not having as much of a major impact on emerging countries or the currency value of other countries as dollar domination comes to the scene, and we would be revisiting price points we've already been at before. I think the market's pricing in the Fed pivot was really just setting up order flow and better price points of interest for this new year and for these Fed interest rate decisions to come. For us to see stock market continue more bullish, or dollar to continue more bearish, or gold to continue more bullish, right? Or gold to continue more bullish, we would have to have a very dovish, neutral Federal Reserve that's feeding into the Fed pivot prayers. So now, let's go through the scenarios and what we need to see from the Feds for the market impact that will correlate and come and result from it, right? So, do you guys mind if I clear the screen of all this information we gave at the start? Because now we're going to be talking about this FOMC to come specifically and the potential scenarios that I see, okay? Now, the reason why I mark out various scenarios that can take place, as well as what to look for and why to look for that, is because I'm not a freaking guru, right? I'm not some Nostradamus. I know everybody thinks my predictions are very accurate, but I'm not always gonna be right. You know what I mean? Plenty of times I've been incorrect, but we're still able to take advantage because we had pre-planned scenarios and expectations on how to take advantage. Obviously, it's fantastic when my prediction is on the money and everything follows suit, but we always like to go through scenarios. So now let's go through scenarios here. I pretty much have three main scenarios. Scenario 1, dollar domination. Hawkish Feds. 50 basis point higher than expected rate hike. Policy statement. Impact. The red's hard to see. Fuck, I already typed it all out, man. I can't copy and paste either because it's just this Epic pen. Can you guys read this? Can you guys read this or no? Okay, cool. It looks clear for me. And I always like to put my balls on the line. I don't just like to say this can happen, that can happen. This is my main prediction. If wrong, adapt to the other scenarios, right? This is my main prediction. Now, what would be ideal for us? Number one is obviously my main prediction coming true. Feds do a more higher rate hike than expected, or the 25 basis point hike, and have a very hawkish statement in speech, shutting down hopes of Fed pivot, talking about labor market data and other economic data still within their expectations, not even close to their goals yet, way more work to do, talking about holding rates through 2024, talking about more rate hikes may be needed, no reason to loosen financial conditions yet. That will lead to stronger one-sided volatility of US dollar bulls, so like GU and Euro USD sells, but UCAD buys, gold bears, and stock market bears, bringing back the dollar domination phase we saw in 2022 and killing a lot of the stock market optimism. If my prediction is wrong, that's okay. What would still be ideal is scenario 2, because it would still bring one-sided volatility and continue to feed into the Fed pivot narrative and feed into that stock market greed even further. This would be a dovish to neutral Fed, doing the priced-in 25 basis point hike or no rate hike at all, which would be a surprise dovish move. What to look for would be the 25 basis point hike and comments such as the declines in inflation are great, US labor market data is worsening and worse than expected, inflation well underway to their goals, we don't need to hold rates as long as expected, we don't need to do any more rate hikes, we can adjust conditions if need be. This will lead to one-sided volatility of US dollar bears continuing, gold bulls continuing, and stock market bulls continuing. What is terrible for us as retail traders and scalpers, if they bring a mixed sentiment, just do the priced in rate hike and copy and paste their last FOMC. This during the day in that FOMC will just lead to a lot of whipsaws, a lot of ranging, a lot of indecision, but the day or week after, you're probably still going to continue dollar bears, gold bulls, and the stock market greed. Because remember, this fight on inflation, this action that the central bank has taken, it can go on, this fight on inflation can go on for years, right? We can get very involved as scalpers and day traders, getting so lost in the day-to-day, the week after week, the month after month. But these guys are focused long-term in terms of years, 2024 to 2025 type of scope they're looking at, with inflation coming back down to 2%, right? So if they do still want to just have a write-off for this FOMC and just copy and paste the last one, you can't really be shocked. They can do whatever the fuck they want at the end of the day, right? But anyways, FOMC scenarios, this is my main prediction. Now, we also have Bank of England and ECB. Bank of England and ECB have a higher probability of being more hawkish. If we get a hawkish Federal Reserve, a hawkish Bank of England, and a hawkish ECB, there's a higher probability that the stock market will have a more aggressive dump. You're having a collective of the major central banks still hammering the sentiment of fighting inflation and still hammering the sentiment of doing rate hikes and keeping rates up for an extended period of time, right? But this is where it can get a little bit tricky for some people here. When you're looking at pairs like GU and EURUSD. If you were to get a hawkish Bank of England, a hawkish ECB, and a hawkish Federal Reserve, this would lead to GBP strength individually, Euro strength individually, and dollar strength individually. In pairs like GU and EURUSD, the strength from the Bank of England and ECB sentiment would be relatively short-lived, and you might get some liquidity grabs to the upside, but dollar domination would take over in those pairs as the world reserve currency, right? The only way GU and EURUSD are continuing further bullish this week is if the Feds are dovish and the Bank of England and ECB are still hawkish. But if all three central banks are hawkish this week, you might see some liquidity grabs on GU and EURUSD, but overall dollar strength will hold more weight. The world reserve currency, Feds are the leader of the pack. Does that make sense to everybody? Now, when you're trading Euro and GBP and you potentially get a hawkish ECB and Bank of England, this can still be very advantageous to play against the weak yen. So getting a hawkish ECB and hawkish Bank of England, it might make trading GU and EURUSD more messy, but against a weaker yen, where the Bank of Japan is still very dovish, keeping interest rates in the negative, this will still keep EUROJPY and GBPJPY very bullish. Obviously, with any of these scenarios, as it's very important economic data, there's a lot of focus on it. You have to still be mindful of heavy liquidity grabs, your broker freezing, orders getting slipped, spread spikes, and so forth. But this impact I'm talking about is once after the dust and noise settles. Does that make sense, everybody? Right? Now, that's for the FOMC scenarios. Understand there's a high probability we're going to range, have lower volume and volatility on our dollar pairs, gold, and stock market up until FOMC. So I'm going to give you guys trade ideas for the sessions to come, but be very selective, risk less, be less aggressive, and save your capital and save your aggression to take advantage of after the FOMC moves. Okay? Now, before I give you guys the trade ideas and what's going on in the next couple of sessions, I just want to break down Bank of England and ECB. Now, in my opinion, Bank of England, I'm going to delete this off the screen. You guys can obviously rewatch this when you wish, rewind it, take a screenshot, take your notes, whatever. All right? Now, BOE and ECB. Bank of England ECB rate decision the morning after Federal Reserve, right? Federal Reserve 2 p.m. in the afternoon Wednesday. Bank of England and ECB Thursday morning, if I'm not mistaken, 7 and 8, right? 7 and 8. And then, yeah, NFP at the end of the week, U.S. labor market data, right? Now, the Bank of England and ECB, in my opinion, should be more hawkish, bringing strength to the euro and strength to the pound against weaker secondary currencies. I would trade it against the yen personally, right? Dollar may get messy as you have the Federal Reserve sentiment will hold a lot more weight and dollar sentiment will take over. But if Bank of England right? Right? So you guys can see that as well. Okay, but anyways, now, if we have all three central banks hawkish today, Euro, USD, and GU after liquidity grabs will end up reversing and turning bearish as dollar strength will still hold the most weight. If you get the hawkish ECB and Bank of England, I'd much rather play that strength in GBP and Euro against a weaker yen, as obviously the Bank of Japan from the previous weeks is still keeping their monetary policy dovish, financial conditions loose, interest rates in the negative, and you can play that rate differential to your advantage with technical confirmations. But anyways, that was just a little bit of an educational breakdown, debriefing, prep for FOMC and the interest rates in terms of impact, scenarios, what to expect, and what to look for and why, right? Obviously, FOMC and these rate decisions are Wednesday, Thursday, and in the second half of the week. This is still a market update and trade ideas webinar. So now we're going to talk about the events we have overnight and some trade ideas for overnight in the sessions to come. Keep in mind, a major reminder, that we're in ranging technical conditions with lower market volume and volatility, as the market makers in Wales are waiting for these interest rate decisions. Hence, dollars ranging at a low, stock markets ranging, gold is ranging at these highs, and currency pairs are also ranging. So even though I'm going to give you analysis and trade ideas, I would personally suggest, unless you get higher volume and breaks above key areas in terms of continuing trend, either don't trade at all and wait till after Wednesday, right? Or be very selective, quick jabs at the market in and out, and don't stress out, be pulling out your hair, fighting these ranges, right? Let me show you an example. As majority of the fundamentals for the Fed pivot narrative, have been priced in, and of course we're having the end of the business month here coming up. We're having the markets waiting for FOMC and the rate decisions. You can see gold has just been ranging at its highs, right? You can see that correlated when you're looking at the dollar here on the intraday time frames and how it's just been in a technical range in its lows. Yen is ranging, equities are ranging. The markets are more illiquid as they're primarily waiting for the information advantage and the driving factor of order flow to come from the fundamental catalyst being the interest rate decisions this week, right? Now, obviously, I still want to primarily, for the time being, for the next couple of days, still stick to a gold bullish bias. We're still very bullish in market structure, still very bullish in price action. We could easily retest better sell zones before potentially seeing what the Feds bring to the table. The trade ideas I'm giving you right now are just for Asian session, London, and New York tomorrow, if volume and volatility is healthy. Then, from Wednesday onward, it's going to be completely dependent on the interest rate decision, where you're going to follow the start of this webinar and the scenarios marked out. Does that make sense to everybody? This webinar is a two-part series. First part was an educational fundamental review, plus prep and scenarios for the rate decisions. This second part is just some trade ideas for the coming sessions, but don't have high expectations. I have very low expectations of movement up until Wednesday. All right? Okay, perfect. So let's look at what economic events we have going on overnight and through the sessions tomorrow. Yeah, so the first half of the webinar, make sure you review it, study it. That's going to be your prep and scenarios for FOMC and Bank of England and stuff like that. The second half of this webinar now is just going to be some trade ideas, some analysis, some potential intraday or scalp trades you can take. But as we're approaching the end of the business month, as a lot of the fundamentals are priced in, as we're waiting for the interest rates and the markets are waiting for that, we have very low volume and ranging conditions. So sitting on the sidelines and not taking a trade is a very good decision to make as well. But anyways, we don't have much going on through the Asian session today, relatively quiet. Now, we do have at least some data through the London session here with Eurozone data. At 1:30 a.m. Eastern, GDP figures from France expected to be a little bit weaker. At 2 a.m. Eastern, import prices monthly and yearly for Germany and retail sales expected to show a slight rebound. 2:45 a.m. Eastern, we have producer prices and CPI for France. Won't have that much weight or impact. 3:55 a.m. Eastern, we have unemployment rate data from Germany. Won't have that much weight or impact. 4:30 a.m. Eastern, consumer credit and mortgage lending approval, which a lot of real estate information and consumer credit information has been priced in with the active rate hike cycles that have been going on by these major central banks. 5 a.m. Eastern, GDP figures from Euro, preliminary, yearly, and quarterly, which is expected to be weaker, could keep Euro a bit softer up until ECB. Then during our North American trading session, we just have some employment costs in Case-Shiller and Chicago PMI, as well as consumer confidence data for the US. This can keep gold a little bit more bearish, or in dollar a little bit more bullish, up until we see what also happens with the Fed interest rate decision. If this consumer confidence is rebounding, if Chicago PMI is also rebounding, right? Now, remember, these are trade ideas for the potentially coming sessions, just based on current technicals and sentiment that's holding most weight. Gold is still bullish in structure, respecting bullish trend in the Fed pivot narrative. We're just in a secondary phase of market structure, which is a consolidation or accumulation at these highs. If we break back above 1923, 1929, 1939, I would still be playing gold buys in terms of scalper day trades over the next coming days. I would start to look for sells on gold if we have breaks below 1919 and breaks below 1912. Very similar type of idea on our dollar pairs, such as GBPUSD, EURUSD as well. If we come back above 236 and 2415, continue the bullish structure, bullish price action, potentially retesting better liquidity zones of interest on the higher time frame. Otherwise, I'd only be selling back below 1.23 at this point, and high probability we may just consolidate, have some indecision until FOMC and the rate decisions this week. EURUSD, if we break back above 1.087, 1.089, I would still be in the bullish bias. Otherwise, breaks below these range lows, I would start to adapt to some potential short-term sells where we can revisit 1.079. But keep in mind, high probability we're going to be ranging, having poor price action, poor conditions to trade for us as retail traders up until FOMC and the ECB rate decisions and so forth. UCAD breaks back below 1.336, 1.331, would still be continuing the dollar weakness sentiment, bearish price action, and bearish market structure. I'd only be jumping back in buys if we break above the Bank of Canada rejection point from the previous week at 1.324. US 30 stock market index just starting to consolidate in range here on the intraday time frames. If we were to still respect 33.5, break above 34K, break above 34.3, would still be playing the volatility index weakness, dollar bearish bias, Fed pivot narrative, and greed in the stock markets up until FOMC. Otherwise, sells below 33K and below 32.8. Last but not least is GBPJPY, which is also just ranging as the markets wait for Bank of England rate decision, and we're overall in this shittier range here. Right? Again, have expectations of low volume and volatility as well. If we break back below the key level in these rejection points, we could easily still come back down to the range lows before seeing buyers come into play. We may even see liquidity grabs like this for the Bank of England rate decision, where if they're still very hawkish, they put the pressure on fighting inflation and rate hikes, we can get liquidity grabs first before continuing bullish. But in terms of scalps or day trades, if we flip bearish below 161, I would see sells to the range lows to set up better buys on the intraday time frames. Otherwise, breaks above 161.2, breaks above 161.5 would still be GJ buys. Now, I've been ranting for about an hour and 20 minutes. We've gone through a brief educational fundamental understanding of the Federal Reserve monetary policy and other policy that the major central banks have followed from the pandemic to where we are now. We've gone through the timeline of events of what was holding the most weight from 2020 to 2021, what was holding the most weight from 2022 to the end of 2022, and what's been holding the most weight now. I also given you scenarios of what to expect for FOMC and the other rate decisions, my main prediction, my main expectation, but also how to adapt if I'm wrong, and what to look for specifically in terms of the Fed statement and Jerome Powell's speech as well as the rate change itself, right? We've also just gone through some quick analysis and trade ideas across main pairs and asset classes that we look at, but we have a very strong understanding that market conditions may be poor, volume and volatility may be low and slow, and we may continue to range up until the Feds and other central banks bring a clean-cut directional bias and fundamental sentiment, where the market makers will, of course, absorb that information advantage and adjust their algorithmic order flow accordingly. I'm going to save and upload this. Make sure you take your notes. Make sure you like and subscribe. If you guys enjoy content like this, I don't think there's anywhere else on YouTube where you can really find content like this, of this much refined information on market fundamentals, economics, and psychology for free, right? No marketers doing this, no gurus doing this, and especially not with the same consistency and effort. So if you guys enjoy it, if you want to help Capital Hungry grow, as a lot of my social media is shadow banned. I even got banned on Instagram today. I can't even send DMs or do IG lives on Instagram for 7 days. So I always get banned on all my social medias. I always get shadow banned because I'm always talking about real world corrupt economics. I'm always talking about masculinity. I'm always talking about how society is weak and going against what they're pushing in the mainstream. So I get shut down a lot. But every single like, every single comment always helps. You can rewatch this as you wish, and I'll see all of you later in this week. No, the live for the Fed speech is only for the private channel. We do a live session during the Fed speech and after it for the interest rate decisions and Capital Hungry private channel. But this should be enough. Go to any mentor that you pay and say, how come you guys don't do this for me? I'm paying you. But yeah, share around Capital Hungry content on your social media pages. It helps a lot. Share it around in other trading communities and groups. Share it around and like and subscribe and comment. I really appreciate it. I'll see all of you next time. Hello? No, I just finished the webinar. It's saving and uploading, but I gotta put the chapters after. The first hour was probably like a main educational, focusing on the interest rates and all that. And then like the last 20 minutes was just some trade ideas, but the markets are probably gonna be fucking dead until FOMC.